Let's be honest. Right now, there is only one story that matters: the AI revolution. It's on every earnings call, it's on every conference stage, it's in every single headline. It's everywhere.
We're told it's going to add over $4.4 trillion to the global economy. Boards are mandating AI strategies. Companies are announcing these massive, sweeping AI transformations. But there's just one problem. A huge one. It's not actually happening. Not really. Not yet.
So what is the real story here? Well, first, I'm going to show you the data that proves the hype is, well, just that, hype. Then I'm going to introduce you to the one company that seems to have actually figured it out. A company with a brilliant business model and a valuation so dangerously high it might just completely implode.
Okay, let's cut right through the noise. Here's the hard data, the stuff you won't find in a glossy press release. According to McKinsey's own State of AI report, while tons of companies are experimenting, only 1%, that's one, describe their AI rollout as mature. Mature means it's fully integrated, it's actually changing how the business runs, and it's showing up on the P&L. Just 1%.
An IBM survey of 2,000 CEOs tells the exact same story. Only a quarter of AI initiatives delivered their expected return on investment. You know what that means for the other 75%? They were just expensive science projects.
And a Boston Consulting Group report is even more brutal. Nearly 3/4 of companies have shown zero tangible value from their AI investments. Zero. So let me tell you what's really happening out there.
What's happening are customer service chatbots, marketing copy generators, internal search tools that work a little bit better, people using ChatGPT to write emails faster. This isn't a revolution, it's an upgrade, a slightly smarter Microsoft Office.
Now, what's really interesting is when you actually dig into the big case studies you hear about. Klarna saved $60 million. Sounds great, right? But that's against $3 billion in revenue. It's less than 2%. General Mills saved $20 million on logistics, on $19 billion in revenue. These aren't transformations, they are rounding errors. But if you look under the hood of the very few cases that actually work, you find one name, over and over again, quietly building the essential plumbing. And that name is Palantir.
To understand why Palantir is succeeding where so many others are failing, you have to grasp one core concept, and it has nothing to do with their AI model. It's about something much more fundamental.
They call it the ontology. Look, every large organization is a data disaster. You've got SAP over here, Salesforce over there, legacy systems from 20 years ago, spreadsheets nobody even understands. You can't just plug a language model into that mess and expect intelligence. You get garbage in, garbage out. The ontology fixes this. It is a living, breathing digital map of the entire operation. Every asset, every process, every relationship between every data point. It creates a semantic layer that makes all that messy data finally understandable to an AI.
This is the absolute core of their entire business. See, anyone can go use a model from OpenAI or Anthropic. Those are becoming commodities. The real value, the deep competitive moat, isn't the AI. It's the proprietary map of the business that allows the AI to actually do something useful. The model is a commodity. The moat is the map. And once this map, this ontology, is embedded deep inside a company, ripping it out becomes nearly impossible. Analysts at Goldman Sachs describe trying to remove it as being exponentially worse than changing your bank account. It creates absolutely catastrophic switching costs. So guess what? No one does it. And their sales strategy is just as clever. Forget those 9-month sales cycles. They run something called AI Boot Camps. Step 1. A potential client comes in for an intensive 5-day session. Step 2. They use the client's own real, messy data, not some polished demo set. Step 3. They build a working AI prototype right there on the spot. By the end of the week, the client has seen real value with their own eyes on their own data. Only then does Palantir ask them to sign the contract.
And does it work? You bet it works. In a single quarter, they closed over $4.26 billion in total contract value. The proof is right there in the numbers. But this number, this is even more telling. 134% net dollar retention. That means, on average, their existing customers don't just stay, they dramatically increase their spending by 34% every single year. You do not see that with a simple software tool. That's what it looks like when you become essential infrastructure.
So, let's recap. We have a brilliant business, a real technological moat, and a super clever go-to-market strategy. Now for the part that should frankly terrify you, the price of the stock. Palantir trades at roughly 100 times forward sales. Just look at this slide. 100 times.
For context, Microsoft, one of the greatest businesses ever built, trades at 12 times. Snowflake, a high-growth cloud star, is at 18. 100 isn't just expensive, it's a valuation from another planet. It completely defies financial gravity.
So let's not mince words here. History has a name for this kind of pricing. It's a bubble. The market is pricing in absolute perfection for the next decade, with zero execution risk and zero competition. That's not realistic.
And you know what? We have seen this movie before, and very, very recently. In 2021, Snowflake hit that exact same 100x sales multiple. The stock then proceeded to fall 80%. And not because the business failed, it kept growing over 30% a year. The valuation just could not survive contact with reality.
So is it that simple? Is the stock just going to crash? Well, maybe. But there's another historical parallel we really need to consider, one that suggests a much more complicated story.
Remember when the dot-com bubble burst back in 2000? Amazon lost 90% of its value. 90. It was left for dead. But the underlying thesis that e-commerce would change the world was absolutely right. The price was just a decade ahead of the reality. The parallel here is crystal clear. The business thesis can be right, even when the stock price is completely, utterly wrong. A crash in the stock doesn't mean the company fails.
So after all that, where does that leave us? Here's my final verdict. Here's what I think is actually happening. The business is real. The technology is real. The moat is real. The price is a fantasy. It is completely disconnected from any near-term fundamentals. In this AI gold rush, almost every other company is just selling shovels. Or in most cases, they're just talking about selling shovels. Palantir is the only one I see that has figured out how to actually dig for gold, how to connect AI to the messy reality of how a large organization actually runs. So watch this company, understand its business, because it is the real deal. But know that at today's price, you are betting on a decade of absolute perfection. That's not an investment, it's a prayer. But if this stock ever comes back down to earth, it could be the single most interesting opportunity of the next decade.